Let's see who's really paying attention and who really understands this stuff. We can go back to our lemonade stand. All right, so this is our lemonade stand company. And it's based in Brooklyn, New York, my hometown. Q1, let's see, Q4 15, most recent quarter. Had revenue of $50 million. Great business. My lemonade stand's killing it. I also sell chocolate for my basketball team. My costs in total were $25 million. And my profits, as I mentioned, were $25 million. Makes sense. My accounts receivable were $10 million, let's say. And let's say Q1 rolls around, okay? Q1 rolls around. Same revenue, same costs, same profits. But as my accountants and my finance team are preparing our balance sheet for the income statement, as we're preparing the balance sheet, we say, okay, John, how much do our customers owe us this quarter? Remember, the balance sheet is as of the last day of the quarter. It's coming up. Pretend it's April. And so we added it up, and our customers only owe us $8 million. So what happened? What happened between here and here? Let's say our cash as well went from Can you tell me kind of what happened here? Accounts receivable, of course. Well, we had outstanding debts from our customers of 10 million. At the end of the quarter, we had outstanding debts of 8 million. We didn't lose any revenue. We made the same amount of revenue. We generated the same amount of revenue, the same amount of profit. But we got paid an extra $2 million of cash. Our cash went up from 50 million to 77 million because we had 25 million from our profits and 2 million from collecting extra collections. So what about the cash flow statement? This is interesting. Our net income, according to GAAP, was 25 million. We didn't have any depreciation and amortization. We don't have any equipment in our lemonade business. We did have a positive change in our accounts receivable balance of $2 million. That's why our cash flow from operations was actually $27 million. But every quarter is different. Sometimes, in the summer especially, we get more customers who buy on credit. So our sales maybe go up a little bit, our costs go up a little bit, our profit goes up a little bit. But our accounts receivable jumps, let's say, to 18 million. We get all the people in the hood who want to buy it on credit. How much does our cash go up? How much does our cash go up? Who's got it? What's the number? So many different answers. Crazy. Who's got the right number? What's my cash balance at the end of Q2? 97. Wow, you guys are crazy. This is the easiest question. Of course, it's 97. I made $30 million in Q2. At the end of Q1, I had 77. So that's 107 right there. But but my accounts receivable grew by 10 million. So I must have not gotten paid 10 of that 30 million. That's going to be 97. Pretty easy. How about the cash flow statement? Cash flow statement is going to have net income, again, of 30 million this time. No depreciation. My accounts receivable is negative 10 million. This is the change to accounts receivable. The accounts receivable delta, change to accounts receivable. You can see it went, instead of going down by 2 million, it went up by 10 million. So my cash flow from operations is 20 million. What do you think the more accurate representation of my operations is? The cash flow statement or the income statement? It's the income statement. It's the income statement. Because the cash flow statement is going to be swung by this accounts receivable. My customers, they have very different ordering and payment patterns. This happens a lot. In the summer, they take on a lot of debt. By the fall, they've paid me back. It's pretty normal. This is a good, accurate representation. I make 50 million a quarter, 60 million a quarter. These are my profits. Whether people pay me back right now or later, it doesn't make a difference. It doesn't make a difference. This is what I care about. These kind of normal swings, like for instance, another one is accounts payable. Let's say my lemonade stand people, they said, you know, we're going to order extra supplies, and my accounts payable balance goes from 5 million to 15 million back to 5 million. Well, I just made $10 million because I used all my supplies and I paid for them in Q2. I don't have to pay for them in Q3 or Q2, excuse me. I used them in Q1. But I didn't make $10 million. I just didn't spend $10 million this quarter. So this can swing a lot. This is what we call working capital. I think some of you know this. Working capital. It's normal for businesses to have changes in working capital. Accounts receivable, accounts payable, inventories. This stuff is going to swing a lot. There's a reason we like to look at the income statement, because even though it's not based on cash, it gives us a sense of the actual business. The actual business. Now, of course, the cash flow statement's there for a reason. It's not an accident. We look at the cash flow statement, it's still important. It's still important. But that's how we think about working capital. So let's look at this. Same thing with AT&T. They collected, in fact, they gave up a lot of receivables. Their receivables went up this quarter, 739 million. That doesn't mean that they made or lost 739 million. It just means the receivables, the amount of money that people owe them, went up a little bit. Accounts payable went down a lot, 1.8 billion. But it's all kind of working capital. It's not called CapEx. CapEx is a little different. We're going to get to CapEx in a second. So cash flow from operations was 6.7 billion. There must be something wrong here. There must be something wrong here. Your brain should not like this. There should be some dissonance, because you'd say, hold on, the income statement, two different income statements, our income statement and the company's reported income statement are both roughly $3.2 billion. So we have two sources telling us AT&T made about $3.2 billion. Okay, fine. And we're going to use that to calculate discount rates and all that stuff. But then they're telling us that they actually generated $7 billion in cash. What happened? Why are we even looking at this income statement if it's so off?